Happy Friday. We've seen the pullback occur, but it's being a little weird. There's components of it that we didn't forecast, although we obviously did forecast a pullback in the market that the market wasn't expecting based on our analysis of what the Fed was saying and our ability to assign credibility to the words versus the market, which seems to be discounting them. That might be part of what's going on here, but we've seen the market pull back quite dramatically, and we haven't seen yields go up. I was not anticipating this. I was expecting the Fed to be hawkish, as they were, and the bond market to make yields go up. I thought that was going to happen. I thought when the Fed was raising rates higher than the market anticipated and raising the long-term rate, possibly, that the bond market would adjust to that, particularly with how convinced they are they're going to keep rates elevated until 2025. And the whole thing here is that they're going to cut rates, at least the market's projecting that they're going to cut rates, and therefore over a 10-year period, 3.4 and change makes sense. I personally disagree with that. I have reasons for disagreeing with that, but, I'm only going to calmly focus on that. I am a stock guy. I'm not a bond guy. That's not my area of expertise. I'm familiar with and view myself as an expert on some of the forces that will drive that market. But, I talked to my uncle, who's the head of global syndicate for JP Morgan, a couple weeks ago at Thanksgiving. I asked him, where do you think rates are going to go? He said rates were going to go down. I was a little off put by that, shocked, but I give him immense credibility doing what he does for a long time and being very experienced at what he does. And I personally didn't think that was going to happen, but it's happened. And let's go over why. There's recession fears out there. If you look at companies like Cleveland Cliffs, not so much today, but yesterday it was getting obliterated. Disney was getting obliterated yesterday. It's had the worst year so far since 1974. Interesting statistic I heard. So there is a bunch of weird things happening now. It seems that the market is fearing a recession, which is possible, but it's going to require a lot to see a recession, I think, because we're at this is the whole thing with the Fed, which is why I think the bond market still might have some adjustments to do. Recession possible. I definitely think the environment in the future is not going to be as good, but the Fed is dealing with a very strong economy here. They're not dealing with a weak economy. That's why they're so confident raising rates, so confident saying they're not going to cut rates, and so confident with rates being held high until 2025. I get it. They're not going to be at the peak rate in 2025, but they're going to be above the long-term rate in 2025. That is important. That's something I think about. Anyways, why not a recession? Labor market's very strong. The Fed is trying to get it to go up 0.9%. That's something, but that's not catastrophic. Let's not forget. It's not like, the top performers, the highest productive people are going to be let off. It's going to be lower productive, lower tier in terms of quality employees that the company says, we've experienced just a touch. Our growth is slowing just a touch. We want to accelerate that growth because we want to be a growing business. Well, if we can't accelerate it through revenue, we're going to have to accelerate it through productivity, which is ultimately going to be good in the end, or by cost reductions. So I think the stragglers are going to be cut. That's nothing unusual. That's probably a healthy process. There's probably a reason why they're stragglers. They might be doing something that they shouldn't be doing. Maybe they should be going to another career path. That's a big part of economics. If you took economics classes, you know that there is such a thing as overheating the economy, which is currently what we're experiencing. The Fed wants to achieve some slack in the labor market, not so that there's homeless people, right? They're not trying to get homeless people. What they want is slack in the labor market so people can switch jobs, companies can find employees. There's a pool and a section of the labor market about, learning new skills, these kinds of things, transitioning industries. The economy is always shifting and evolving. Certain mechanics might not be needed in the future at the same levels, although there's currently a shortage of them because they're afraid of that, similar to oil companies. So, recession, possible, but it's looking to me more like flat economy, not necessarily recession, but not booming growth. Prices slowly continue to come down, hopefully, but not as quickly as the market seems to be projecting. The market seems to be projecting insta fall and then recession. I don't think that's going to happen that way. I think the Fed is going to have to continue to raise rates, and we're going to see some areas be weak. Some companies are going to be weak, and that's where we get into what we're doing. Okay, obviously we're seeing consumer electronics pull back. We're seeing goods in general pull back. How are we playing this? How are we getting specific here? We're short Apple. We're short the stock. We're short the options. Why are we short Apple? Like I just said, consumer electronics pulling back. It seems good inflation was the first one to get hit. That makes a whole lot of sense. In addition, there was a lot of pull forward of demand during the pandemic. The Apple iPhone upgrade cycle was lengthening pre-pandemic. That trend was reversed during the pandemic as there was a lot of more time spent on the phone, on other electronics, work from home, etc. That gave them a boom. They also experienced benefit from the there is no alternative TINA trade. Treasury yields being so low, there is no alternative. You have to go to something like Apple to get growth on your wealth and not lose it to inflation. That's getting unwound. So I'm not saying I don't like Apple products. Okay, I'm recording this on an iPhone, but this is how I'm thinking. Apple was in a Goldilocks period for the reasons I laid out, and they're now entering a less than ideal Goldilocks period, but the stock is still priced well above historical levels. Additionally, the China situation is going to slow down this quarter. Part of the reason people were justifying the Apple price was that they deal with the higher end consumer, and any slowdown seen in the lower tier phones would be made up for because rich people are going to spend even more every year, aren't they? Well, guess what? iPhone 14 deliveries have been laid out to after Christmas for some time now. So I'm not too sure about that. I think they are experiencing some slowdown in demand. I think they're also increasing the slowdown in supply. And it's going to be a tough quarter. And that's just the nature of the economy. It's not always the same thing every single time. There's cycles. Apple seems to be honestly handling the cycle pretty well. Yes, they're not going to have the supply they want, but they are investing in their long-term brand. They're clearly still having the supply-demand imbalance, and that's what Ferrari does. So Apple, Ferrari, very similar in some ways. Seems like it's not all doom and gloom. There seems to be maybe some optimism and strategy to it in the long run, but that doesn't take away from the fact that the stock is well above historical multiples, and it doesn't take away from the fact that the S&P 500 overall is expensive relative to historical multiples on earnings that might be a little too high, on rates that might be a little too low. So I see a number of forces that are negative that still might play out. Additionally, there might be some credit situations that come up. The Fed is asking for comment on that. I have left comment. You will be able to read my comment. I don't know how good of a comment I left. I just appreciate the opportunity to share my comment, but I just shared what made sense to me. You'll be able to look it up and find it. You can look me up, and there's other ones I've left about Larry Fink and oil prices. And that gets us to our next thing. So we obviously have laid areas to go short, or at least not be overexposed or put our money towards right now. However, there are areas that we're continuing to add to, continuing to nibble at. These are the energy areas, the old-fashioned fossil fuels. I get it, there's a phasing out. But let me just give you this fact. In 2013, we hit all-time high coal production. We have not hit a new all-time high in coal consumption since today, from 2013 to today. So coal production, which is the leading purveyor of CO2, i.e. also known as AKA plant food, is now at record consumption after having not been at record consumption since 2013. Oil, conversely, seems to be hitting record consumption every year except 2020 and 2021 because of lockdowns. So we expect emerging markets to continue to grow, and they grow faster than us. We expect them to prioritize cheap and easily accessible fossil fuels for the next few decades because they are not wealthy enough to invest in renewable energy. That's going to be a thing for wealthier countries to adopt first and emerging markets to adopt later. These emerging markets are very massive. Yes, their economies aren't the size of the United States. We're talking India, we're talking Africa as a continent and the many nations within it. Lots of people, lots of energy consumption if they really want to have a growing economy, and I assume they do because that means food prices go down, means nicer homes, healthier children, these kinds of things which are important to life. I think there will be continued robust demand for these fossil fuels. They're still trading at single-digit multiples. I get it. A lot of it has to do with previous oil prices. SPR is coming offline. You saw today they're adding it. I saw today rig counts are down. I saw that Nebraska's also taking some barrels offline. Seems like the bottom is in for oil prices. So that's what it seems like. I'm not saying it is. That's what it seems like to me. You do what you want with that information and you make your decisions. This is where I'm adding stocks. I said earlier in the video and in past videos what I'm avoiding and what I'm doing to capitalize from that. And we'll just see what happens. We'll just see what happens. It's a weird time. As I said, bond yields are weird. It's been a weird market all year. And I hope you stay on top of the game. So that's today's video. And until next time, peace out.